Let's start by learning about stocks. Stocks, also known as shares or equities, represent ownership stakes in companies. When you invest in stocks, you become a shareholder and participate in the company's success through potential capital appreciation and dividends. Investing in stocks involves careful planning and making smart choices. From picking a brokerage to understanding past performance, we'll offer some tips on how to begin your journey in the stock market. Let's look at some advantages of investing in stocks. First is the potential for high returns. Historically, stocks have delivered higher returns compared to other asset classes over the long term. Despite short-term volatility and market fluctuations, stocks have generated significant wealth for investors who have held them for extended periods. And second is liquidity. Stocks are highly liquid, meaning they can be easily bought and sold on the stock market during trading hours. This liquidity provides investors with the flexibility to adjust their portfolios quickly in response to changing market conditions or investment objectives. Investing in stocks is like putting together a puzzle. It's all about doing some research and making smart choices. Here's how you do it. First is research. Before investing in a stock, conduct thorough research on the company's financial health, business model, competitive advantages, and growth prospects. Analyze historical financial data, including revenue, earnings, cash flow, and profit margins, to assess the company's performance over time. Second is reviewing historical performance. Review the stock's historical price movements and performance relative to the broader market and industry peers. Look for patterns or trends that may provide insights into the stock's future potential. Keep in mind that past performance is not indicative of future results, but historical data can help inform your investment decisions. Finally, it is evaluating fundamentals. Evaluate financial metrics like the price-to-earnings (PE) ratio, price-to-book (PB) ratio, return on equity (ROE), and debt-to-equity ratio to assess a stock's value and financial stability. Look for companies with strong fundamentals and a track record of profitability and growth. You can buy stocks from brokerage firms like Charles Schwab and E-Trade, which offer user-friendly platforms, educational resources, and competitive pricing. Compare features such as trading commissions, research tools, and customer support to find the brokerage that best suits your needs. Let's now look at ETFs. Exchange-traded funds. ETFs are investment funds that trade on stock exchanges, much like individual stocks. ETFs typically hold a diversified portfolio of assets, such as stocks, bonds, commodities, or real estate, and aim to track the performance of a specific index or benchmark. ETFs offer benefits such as spreading your money across many different investments all at once. Instead of putting all your money into just one company's stock or bond, which can be risky if that company has problems, ETFs help lower your risk by investing in lots of different companies or bonds at the same time. This way, if something bad happens to one company, it won't hurt your investment too much because you've spread out your money. ETFs usually have lower fees than other types of investments like actively managed funds. This makes them a good choice because you get to keep more of your money. ETFs track a certain index or benchmark without much active management, which means they don't have to spend as much on fees, giving you better returns on your investment. When selecting ETFs for your investment portfolio, consider the following factors. First is performance. Check how well the ETF has done compared to similar investments in the past. Look for ones that consistently did better over time. Second is expense ratio. Look at how much it costs to invest in the ETF. Lower costs mean you keep more of your money, so it's better to choose ones with lower expense ratios. Third is asset under management AUM. Consider how much money is already invested in the ETF. Bigger ETFs usually have more people trading them, which can make them easier to buy and sell as they are more liquid. Finally, look into the companies that make up the ETF's portfolio. Consider factors like what industries they're in, where they operate, and how big they are. Choose ETFs that align with your investment goals and beliefs. You can also buy ETFs from brokerage firms like Charles Schwab and E-Trade. Finally, let's take a look at bonds. Bonds are loans that governments, cities, or companies use to get money. When you buy a bond, you're loaning money to the issuer. They pay you interest regularly and return your money when the bond matures. Bonds offer the following advantages. First is steady income. Bonds provide predictable interest payments, making them ideal for investors seeking a steady stream of income. Whether you're saving for retirement, funding education expenses, or supplementing your salary, bond investments can generate reliable cash flow to meet your financial needs. Second is capital preservation. Bonds are generally less volatile than stocks and can help preserve capital during periods of market turbulence. By investing in high-quality bonds with stable credit ratings, you can minimize the risk of capital loss and protect your investment portfolio from downside risk. Here is how you can get started with bonds. First is assessing the creditworthiness of the bond issuer by examining credit ratings assigned by rating agencies like Moody's, Standard & Poor's, and Fitch. Higher-rated bonds are considered safer investments because they have a lower risk of default. Second is to understand how changes in interest rates affect bond prices and yields. Generally, bond prices and interest rates have an inverse relationship. When interest rates rise, bond prices fall, and vice versa. Finally, spread your bond investments across different issuers, maturities, and credit qualities to minimize risk. Diversification helps reduce the impact of credit events affecting individual bonds and enhances the stability of your investment portfolio. If you want to buy U.S. Treasury bonds directly from the government, you can use Treasury Direct, the U.S. Department of the Treasury's online platform. Across all investments we covered so far, here are some risks associated with investing which you need to be aware of. Stock and ETF prices can fluctuate in response to changes in market conditions, economic indicators, and company-specific news. Market volatility can lead to short-term losses and create uncertainty for investors. Bonds are susceptible to inflation risk, as high inflation erodes the purchasing power of future interest payments and principal repayment. Bonds pay fixed interest rates, which don't increase with inflation, so the value of bond earnings might decrease over time when inflation goes up. So that was our crash course in investing, covering stocks, ETFs, and bonds. Armed with this knowledge, you're well equipped to embark on your investment journey with confidence and clarity. Remember, investing is a long-term endeavor that requires patience, discipline, and a commitment to continuous learning and adaptation. By diversifying your portfolio, conducting thorough research, and staying informed about market trends and economic developments, you can build wealth and achieve your financial goals over time. Here's to your success as an investor. As you continue to invest more, may you see your wealth grow exponentially. If you found this video helpful, please subscribe to our channel for more financial insights. Thank you for watching, and see you on the next one.